All of you know what initial public offering is. We have seen many IPOs coming in recent times. Hi, I'm Sujit. In this video, we'll learn more about what delisting is and why will company opt for delisting when it is on exchanges. Delisting is a process by which the stocks or shares of the company are removed from the exchanges, that is NSE and BSE. In simple terms, delisting is completely opposite of IPO. In initial public offering or IPO, what happens is private company goes to public by issuing shares and getting listed on stock exchanges. What happens in delisting is the company becomes private from public and it buybacks all the shares which is there in the exchanges, and further there won't be any shares left for trading. So why would company delist itself from the stock exchanges when whole point was to get listed and to raise funds easily from public? So there are two main types of delisting. One is voluntary delisting and involuntary delisting. One is voluntary delisting and involuntary delisting. Involuntary delisting, there are various reasons. One is failure to pay listing fees, then failure to comply with listing agreements, then history of not addressing investor complaints, unfair trading practices by promoters and its managers, bankruptcy, other malpractices. In voluntary delisting, there are various other factors why a company would like to delist. One is promoter has higher chances to buy back shares at a steep discount as compared to its fair value. Next is annual listing fees turns out to be significantly costly. Third one is making strategic business decisions takes time due to mandate of taking shareholder and board of directors approval. And the last one is other cost of being public entity like audit and compliance cost, and which is unnecessary. We'll understand the process of delisting by taking one of the recent examples, that is Vedanta. Vedanta's delisting offer is one of the biggest delisting offer which India has seen. On 9th of October, the delisting process started. So in this process, there was bid for 137 crores by the parent company Vedanta Resources. Vedanta Resources agreed to buy back shares at 87.5 rupees, which was at discount to the current market price. But there was counter offer by LIC at a premium of 267%, that is 320 rupees. If parent company of Vedanta paid 320 rupees per share, then LIC would be selling the remaining shares of it. Many retail investors were ready to sell their Vedanta shares at 150 to 160 rupees. But LIC asked for 320 rupees. LIC holds 6.17% of Vedanta shares. So the price discovery was to made accordingly. Price discovery is done by looking at all the bid price through which a company can determine the threshold levels. So the price discovery is done by reverse book building process. We'll understand this by taking Vedanta's example. In the case of Vedanta, around 90 crore shares tendered below 160 per share, 15 crore shares tendered between 150 to 300 per share, and 32 crore shares were offered at 320 per share. This 32 crore shares were offered by LIC. The 32 crore shares were the total cumulative quantity tendered, which is equivalent to 134.1 crores of shares, which meets the 90% threshold limit. So the discovered price is 320 per share. So if the discovered price, that is by reverse book building, is not acceptable by the company, they can counter offer it. This can be done by the company within 2 days after the discovered price is set. In case of Vedanta, the delisting price or the discovery price was way above what Vedanta had offered. Vedanta had offered at 87 rupees and the discovered price was around 320 rupees. So on Friday, the news came out to be that Vedanta has failed its delisting procedures because it couldn't buy back the shares at 320 rupees. The delisting process of Vedanta was unsuccessful, and we need to wait and watch how this episode stands out to be. As on 12th October, Vedanta was trading at 100 rupees, that is 21% lesser than the previous closing price, and we need to see how it turns out to be in upcoming days. I hope this video was informative. For more such content, please like, share and subscribe.